looks like it's the 7th of April, and we got a flat market. Seems Wednesdays every time the knuckleheads up there in Washington want to talk about money, we always start off kind of slow. You've got to hear what the money printing people have to say. But neither here nor there. We make no decisions off of what policy is. We don't care. As long as companies are making money, that's all we're interested in, because we're going to benefit from whatever they're doing. So if if you want to follow it, that's up to you, but I could care less. It's just one less thing to think about. If you understand a company's making money, most important thing you can do is to protect yours, because when you're looking around for stocks to buy, you should be looking at is the ones that are making money. If you want to take risk, hey, you can go for those new companies that are setting all-time highs and see if you can't get in right at the highest level that they can. It's a crazy world we live in, but the hype around all these companies, it's like, let's go take a look at, somebody was talking, I think it was Jim Cramer was talking about getting into MCD, buying MCD, that's McDonald's. And it's like, okay, I don't have any problem with that. It pays dividends, but how much are you going to put into it? It pays like $5 and some odd cents. So, you got to scale in based on the size of your portfolio. Most people want to get in, say, hey, I should have got in down here, so that's great. But how'd you know that that was the so-called bottom? We don't know if this is the top. This thing could go to $400. We don't know. Especially if they start selling, non-meat burgers, which is probably happening. I don't know. But your main focus should be on how much you can make on the size of your portfolio versus what they're telling you should make. It's all about scale. On something like this may even come up on a scan in the future. It has in the past. We've traded it many times, but just to jump in because Jim Cramer tells you to buy it because he thinks it's going higher. Good luck. I hear this all the time. I don't tell anybody what to buy, when to buy it. What you do is you have a plan, you stick with it. You get a list of stocks. You decide based on the size of your portfolio, and you move forward from there, and you take your profits constantly. That's what it's all about, making money. So, charts mean nothing. They're just a reference. If you're looking at, what's happened in the past over here, say, well, hey, because it did this, it can repeat itself in the future. That if you get stuck in that train of thought, you're going to lose money all the time. What you need to be understanding is how to manage your portfolio. First and foremost, how much money you have versus what they're telling you to buy. If you ever notice, when you open up any platform, the default setting is 100 shares. They've got you from the get-go, and you're trying to learn. I'm going back 30 years, and I always wondered why, I couldn't make any money because I was constantly setting stops, trying to protect my cash. And that was the wrong way to think about it. If you think about it, turn it around. Say, well, if you're willing to lose $100, then that's all you should be investing, right? So if this is $98, you should be buying one share of that. That's your train of thought. But what most people do is they're like, well, I got to buy 100 shares, so I got to put $9,892 into this. That's all I got. I got $10,000. Yeah, I can buy 100 shares of that and say, hey, great. If it goes up, you win, right? Depending on where your target is. But what happens when that comes down? What are you going to do? You're going to put that stop in there? You're going to guarantee yourself a loss. Let's turn it around. Don't buy one share. Now you're protected because you're never going to sell it. The idea being is if these things pay dividends, right? Every stock that in your list should pay a dividend. If it doesn't, you're not buying it. If you have a small account, you should be looking at yield. As your account grows, you can get into more volatile stocks that still pay dividends. Let's take a look at some of these CEFs. Right? CEFs are something that pay monthly. Right? Now, if you look at the yield, we're going to switch over to a different style of chart here, and we'll look at the yields. Okay, or is it BTZ? Okay, there's 6.9% on your money. Okay, that's if you're wrong. Okay, so let's take a look and see. You have things called. Oops, sorry, got on the wrong one. Okay, so right now let's get this stuff off of here. Right now this one's 173 shares max. Okay, so we're at 36 shares. So we can go up to 173 based on the metrics. So based on the size of your account, this particular account shows 65,908. So we have a small percentage at risk, looking at $1 per year. So right now this particular stock will pay you $36 a year if nothing else happens. You look at this, 6.9%. Where are you going to get that on your money? And this pays monthly, 8 cents. Now multiply this by thousands of stocks. You'll start to pick up on what we do. We're not ever selling any of these stocks. Doesn't matter if the market's coming crashing down. We're going to still collect this dividend amount. We want to continue to bring in cash. Cash flow is the most important thing in your portfolio. The worst thing you can have is what most people are going to have here when this market finally corrects. They're going to have their portfolios and they're going to be buying and buying and buying, keep on, buying more and more shares in that one particular stock, and then it's going to come down. Well, what are they going to do? Two things. They're either just going to sit and hold and collect dividends, which is smart, or they're going to get scared because they see their portfolio going in half, and they're going to sell at some point because they've been told in the past to protect their money with stops. That's a losing situation, losing strategy. If you're buying something, stick with it. When a company stops paying dividends, that's when I stop investing. Like this one here, CHKR, it's still paying dividends. It's so small, but we've had it in this portfolio for so long, and look, there's hardly any money left in it. Still paying the dividends on this particular number, the 595. Doesn't matter what the unrealized number is. This thing has been in this portfolio, I don't know, for 15 years. This won't go away. So eventually we'll take a loss. If it comes or gets delisted, it's currently an OTC, a pink sheet. If it comes off, we'll actually take a loss. And we'll report that. But in the meantime, we've been collecting dividends. At one time, I think this paid around 9%. This was part of CHK, Chesapeake. It's just another one of those deals that, hey, some of them don't work out. But we're talking about leaving them in your portfolio till the end of time. This thing may come back. I see it all the time. But you have to be willing to play this long term. If you're not, you can't make any money. That's just the nature of the beast. It's a long-term endeavor. Pup eating the other dog's food to stop that. All right, so where we're at, let's look. Today we don't have any dividends coming in, and we don't have any ex-dividends for tomorrow. So we'll be concentrating on what will be traded. Now, we may not have anything traded today, right? So two things can happen. Either the market goes up, market goes down, or it stays the same and nothing happens, and it's just a blank day. It's rare, but if we sell something, that's fine. It's a positive, right? If we buy something, that's a positive. We're going to start making dividends on whatever we buy. So the whole idea is to continue to increase. Now we talk about the title of this is Dividend Collection 2.0. Well, how do you increase your amount of dividends with doing less? Well, the whole idea is when you trade, okay, if we let's take one that we've already sold at. And these are all positive gains so far. I guess this is from yesterday. Well, since Monday. So we go back here to the 5th. So you can see we have 4 buys and let's see, 8, 9 sells. All right. So let's just take this one here. Small gain, right? 437. But what does that gain represent? ARE. When we look at that, okay, we see it closed out here. And let's go to the portfolio. I'm sure we're on the right one. Well, we'll have to go to a watch, just generate it up. Okay, so we can see that the amount was 436, and that's exactly what we made, right? Or 437, so we're a penny over. That's a full year's worth of dividends based on this price. That's what we targeted. That's what we earned. We look back, that's what we got. Full year's worth of dividends. Sure, we only had 1 share, but it was based on the size of our account. The price has a lot to do with it. At 171.75, who can afford 171.75 multiplied by 100? Okay, just add 2 zeros. That's $17,175. That's a huge part of your account, right? And sure, hindsight, oh, well, you made that. You must have known something. I had no idea where the market's going. Okay? If you think you know where the market's going, you're going to lose. It only takes the one to handcuff you, and now you can't trade anymore. Right? Unless you put more money into your account. And this is where people start borrowing money. This is what gets them into trouble because they feel like they're missing out. FOMO. So what we're trying to do is hit numbers. Okay, numbers of occurrences. We're hit 1, 2, 3, 4, 5, 6, 7, 8, 9. We got 9 total. Okay, so far this week, just on this one account. I manage 15 or 16 different accounts. All right, and some of them mirror each other. Others, different times. We bought in different things. It's just a numbers game. So let's go back here to McDonald's. So, of course, looking at that, I can tell based on the size of this account, and this account is 65. Well, it's more than that, but let's just say it's 65. We know that we can only buy 1 share. So we're trying to buy, or we're trying to make $5.16. So if we look at this chart, you're saying, where's it got to go? At 5.16, it's got to go up here, right? 5.38. We don't know. I mean, it could go there, but it could come down. It could stay the same. It doesn't matter. The whole idea is we know we're going to get that $1.29 on May 28th, right? Start multiplying. Just keep the number in your head, 1,000. Anytime I say 1,000, right, multiply it by the dividend amount. So if you have 1,000 different stocks doing whatever, 1,000 times 36 cents, 1,000 times 10. Okay, it's a numbers game. If you play the numbers game, you'll win. You have to be spread out. Diversification, yes, it happens naturally because of stock movement. You don't have to worry about that. If you were to take a look at all of our portfolios, they're not weighted in one sector. I don't even have to do it. The scan takes care of it because we're looking for stuff that's moving. Stocks are constantly moving. It's not like one stock just goes up for all time and one stock goes down, or they all stay the same. Everything's in flux. Everything is moving. So your focus has to be on the size of your account. If you're under 100,000, you really have to, I don't care how you break it down. We offer a scan to, all our members that allows you to see your account in a different way. And if you follow us for any amount of time, you'll start to see that if you're involved in more and more stocks that are paying dividends, you're basically collecting rent from hundreds of different locations. I like to picture it like, whether they be businesses or homes or whatever else, they're paying you. And you just look at each individual percentage, right? And they all average out to be, on this particular account, 9.29. Now this constantly changes because you're in and out of the market. Maybe you bring something in that's higher, a higher percentage than that. It's going to move the percentage up. Here's one that's 1.2. It's a high dollar stock, right? $145. It's only paying $1.72. It's 1.2%. That's still higher than what a bank is going to give you. So you put $145, let's just call it a bank. You put it into a savings account. It's going to pay you 1.2% per year. But we're trying to get that 172 as fast as we can. Let's look at AXP, right? That's the difference, 172 above from where we bought it. We want to target that dividend amount for the year. If we can get it in 1 week or a couple of days, we're ahead of the game. It's simple. But if you're trying to play the big game and you're trying to play with the big boys, and hey, I want to buy 100 shares and I want to hit that 172, right? Yeah, you'll make $172, right? Because it moves a dollar or $1.72, 172 bucks on 100 shares, right? You just multiply it by 100. Simple math. This is where the greed comes in. But you never think, you're always thinking the positive. Hey, yeah, I'm gonna win, right? Because you see it happening here, and I can duplicate it all the time. But we're talking, you don't see the other side of it when it goes down. What are you gonna do now? You got one share and it's going down, right? If it goes down, this would be our next entry point down here at 117. That's $30 less. So how much are you down? $30, not 300. But what do most people do? And they're getting scared. They're like, hey, I'm going to jump. I got 100 shares of this. I got to get at. Every time you take a loss on the market, you're that much further from financial security. Just think of it that way. Don't take losses. If it's forced on you, a company goes out of business, you're just like, you got to look at it and say, okay, why did I invest in that? Oh, it didn't have any dividends, like Tesla. Okay, I'm going to buy it at $500. Well, it's split. It's like, who cares? It's not paying you any dividends. Something splits, it's still the same value unless it goes up. Now you got more shares. Yeah, it multiplies, but when are you going to take profit? It doesn't mean anything until you take profit. Too many people stick their money in the market and they're collecting dividends, but they're reinvesting them as the stock price is going up. Look at how many people are involved in the market now that have been sitting at home. This market has been pushed higher by people shoving money into the market. They keep blaming the Fed for it, and I'm like, whatever. I mean, you can blame whoever you want for it. But the market keeps going up, and people keep reinvesting those dividends. Say, look at how many shares I've got. And it's like, yeah, when it starts to come down, it's a double-edged sword. It's going to come down on your head. It's, and most people are going to get scared. I feel sorry for the people that are, working for a living, sitting at, going 9 to 5, which is nothing wrong with working. I've done it for many years. I'll probably do it again if I want to. But if you're putting your money in and you're not managing it yourself, you're going to get hurt in this next downturn because you're not going to be able to get out. You need to take profit on the way up. You can always get back in, or, well, it's like, manage your money based on the size of how much you have, not based on what the default program is or what somebody tells you. Buy it. I've heard so many people say, Well, if you don't buy 100 shares, then how are you going to make any money? It's like, what does the number have to do with anything? You know, if you can, 100 shares is the same. 100 shares in one company is the same as one share in 100 different companies. I'll take the 100 different companies every day of the week. But if somebody ever tells you they know it's going up or you know it's going down, big thing going right now, it's like, oh, you know, people, there's some guru out there saying the market's coming down. Okay. So what's your advice? You know, they never give you advice. They just tell you, you know, oh, well, the market's coming down. I guess they just feel good about, you know, hey, I can call the market direction. They've been doing it ever since the stock market opened. That's how people make money, you know. Come listen to me. I know what I'm doing. But then when you ask them and say, well, how do you make money off of it? Well, I don't know. I just know what direction the market's going. Because I can't give you any financial advice. So we're working on 306 days without a loss. I think the last loss we took was I think it was a small, it was some type of merger that happened and the stock ended up being delisted. And we had to show a loss because whatever money was left in the spinoff, I don't know what they actually did. I didn't really pay too much attention, but it showed up as a negative, and it was a negative for that day. We'd actually profited a little bit on others, but it showed as a negative, and I think it was like a $15 loss on the day, and we didn't have dividends paid. So, I mean, it was a loss. You had to claim it as a loss. But it's not a $15,000 loss. It's not like, oh, hey, we're taking $200 loss this week and a $400 loss the next week. Next thing you know, you're like, hey, man, I keep losing money in the market. I've been there, done that back when I first started investing and trading. You don't want to be doing that. I mean, you'll realize when you find something that works, you'll want to stick with it and add to it. You never want to take away from what works. But greed has a funny way of changing people's personalities. When something, you know, when it stops working, that's when you need to change it. You need to be able to identify that. But too many people don't spend enough time understanding and managing their own money because it's real easy to whip out a credit card and, well, just let me put some more money in there. Next thing you know, they're down 10 grand trading, you know, and you see it all the time. There's many people today are doing the exact same thing because they're trying to become millionaires overnight. If you never take any losses, you'll always be growing your money. No, what's nice too is, you know, when you have a portfolio and you look at it and say, hey, I'm making 8% on 60 grand, just make it 10% for round numbers. You know you're going to make $6,000 for the year if, like, let's say you couldn't trade or you couldn't get online or do whatever. But look at all the people that have to trade on day-to-day basis. They got to be in front of this computer. I mean, I'm on the computer for what? 1, 2, like 2.5 hours per day, you know, to look after all the accounts. Because I can go through them really quickly. I know what I'm doing. But, you know, here's a CEF that just keeps on moving up. Now, if you want to sit there and analyze why it's going up, I mean, there's several different reasons. I mean, it's one of the higher paying CEFs. I mean, people aren't stupid. They're looking for the high payers, right? And go back over here to Classic and we'll look, what's it paying? 6%, right? But it's paying $2.46. This is where people get mixed up. $2.46 at 6% and $1.76 at 6.5. Well, if everything was equal and the price keeps moving up, your dividend yield goes down. So if this was the same, and the price goes down, your dividend yield goes up. If you don't understand these basic premises of money and, you know, percentages, You need to focus on it. I talk about it all the time because this is the most important stuff. The 246, yeah, but 6% on your money is pretty good. 3% is good on your money, but look, you're getting paid $3 a year versus 246. It's a difference in price. Look, 94.61 versus 39.26. That's how you get the difference. Price goes up, yield goes down. So understanding these, it's nice to, oh, hey, I want to target this, but this one actually falls kind of at, this has been in this portfolio a while. You can tell by the position size, but it's paying 12.5%. And it's pretty close because we're still down $1.50 or 154. But that would actually, if you move it up to equal, it would probably be around, let's say 12 or let's just say 11.5. Take a percentage point off of that. But we don't initiate new positions unless they're over $1.20. So this one, unless it's a CEF. Okay, I just want to make that clear. CEFs are money makers because they pay monthly, right? So it's compounding your money, and it's putting cash into your cash account quicker. So these smaller accounts that we manage for folks, it's going to increase the amount of cash quicker, and we can redeploy that into other CEFs, and it just has that compounding effect on a monthly basis. You're saying, well, you're only putting in, 18 times 8 cents. And that's like, yeah, but you don't understand. When you start getting thousands of stocks doing this per month, it starts adding up. You're going to start off slow. I mean, on this particular account, let's go to the small one that we show here. Okay, this account only has, 20, well, it has about 27 in the account, but invested right now is $20,970. So it's earning 5.97%. So when we look at these, we're like, okay, this AGNC, it's been in this account for a while. You can tell by it's at max shares, or close to it, 96 versus 84. So just on a side note, we could add to this position if it was below our average cost, that green shaded area. So we're above water, right? We're real close to selling that position out, but it may never hit it. It's been close. Would it get up there like within a penny, right? But it never closed out because it's got to hit the 10. Plus, you have to have enough for sale. Somebody has to buy all of these shares. So there has to be the buyer out there to buy that. It doesn't just go up and hit it because there's some, algorithm out there telling you that, Interactive Broker is going to buy it from you. That's not how it works. But regardless of what happens, we're collecting, was it 84 multiplied by 144? I'm sorry, by 12 cents. Oop, 0.12. So $10.08 per month. You're like, well, that's not very much. I said it's 8.5%. And some people will say, well, why don't you just take all your money and stick it in there at 8.5%? And I said, well, you can do whatever you want. But, it's like I say, there's no guarantee that sucker's going up. And CES would be your smarter route if you're going to do something like that because they don't move much. Their volatility is low. So you can continue to add to it. But if you're adding on the way up, you're actually making your position worse. So you'd want to buy something else. So like if you had that 20,000, there's so many different ways you can do this, but we're talking about how to increase, your dividend collection, right? Divide that by 2970 divided by, how much is it, 1702, right? So you could get 1,232 shares. You can actually do fractions too, but let's see what you'd make per year. Then you'd make $1,700. I mean, there's nothing wrong with doing that, but then what's your target to get out? Or are you just going to sit on that and make dividends at 8.5%? If it goes down, the dividend yield goes up, right? But your dividend amount stays the same. Now it can change. It can go up and down. Usually CEFs change on a year-to-year basis. All right, looks like the market's open. And of course, nothing's happening, right? We have no buys, no sells. Now, of course, we don't have all the stocks, and I guess I spoke too soon. So we sold AXP, this one we happened to be looking at earlier this morning. And let's see what account that's on. All right, so it made $1.74. What's up there, buddy? So let's take a look and see. I'm going to post this to Twitter. We have some followers over there. So 172 was the dividend for the year. And what did we clear? 174. Right? So we covered our federal charges, you know, like a penny or something like that, because we always go up to the next, like, half cent or whatever, 5 cent or 10 cent level, just to cover any other little fees in there. So we hit our target of 1.2%. We're very particular about our rules. Don't mess with Sasquatch. So we sold AXP. So we'll take this off the chart, get rid of this. AXP, we'll post this to and simple as that. So if you follow that way of thinking, you know, you can make these occurrences in the market and you can be a player. Now remember, I'm paying $1 per side, and if you know, all these brokerages, at least for now, or last, what has it been, 2 years, maybe even longer, I can't remember, but when you had, oh, what was the name of that company? Robin had come out and they went to 0 fees on equities. It really changed the dynamics of trading in the market and allowed a lot more people to start trading equities. And, you know, maybe some people caught on to this, but I've been doing it for the same way for 20 some odd years now, because the amount of commissions really hurt people. You know, everybody thought a discount fee was $7, but it never was. Interactive Brokers has always been $1 per side, and I have no problem paying that. And here's another one. See, this is, I try to find these ones that are just getting close, so I know, and it's more for, it's not to sit there and, you know, toot my own horn or whatever. I mean, if it hits, it hits. It's just, it happens every day, right? And you just look, it's got to go to 34.40, and it's, what's the high on this? 34.35. So it's been within 5 cents. And, okay, what was the last one? AXP and COF, Capital One Financial. What do the two have in common? They're both financial products, right? So we're looking to hit another $1.60, right? So if it goes up and hits it, we're at it. It may never hit it, but we're going to collect that dividend. but are we in up to our eyeballs? I mean, $134 for a stock's pretty high, right? Especially on a small account. Now, if you're Warren Buffett, he's buying ratios or scale based on the size of his accounts. He's not putting, oh, hey, he's not buying 100, let me tell you. He's buying millions of shares. So, I mean, you gotta go by scale. So scale back, take it easy, understand how to make money, and understand how not to lose money. How you're going to lose money is using leverage. There's time and a place for it, and if you totally understand it and you get a degree in economics or whatever, you can still lose money because you don't understand the markets and you don't understand scale. But if you do it for any amount of time, I'm going to give you a little fast track here, and if you catch up on it or catch on to it, you'll do a lot better in your trading. And you won't be stuck in front of your computer because you know that, hey, I want to go on vacation for a week. When you come back, you're either making money or you're making money. There's just two levels. You're either making dividends or you're making dividends plus your profit on your sale. So we have another positive day, even though it's a small gain, $1.74. It's still a gain. Don't poo-poo it, because now when you scale it up, these particular accounts, that's on a $60,000 account that we made that trade. When you start scaling it up, once this gets over 100,000, just double that amount, because now you're doing 20% of max shares. Now you probably won't know what I'm talking about, but now all we're doing is looking around, seeing what's actually moving. So we're looking at large moves, right? And we see 60 cents. It's not a big move. We're just trying to get a feel for what the market's doing. If we see a down move, take a look at it. Are we close? Is our structure there? We just repeat the same thing. It's called discipline. If you don't have discipline, you just want to go out there and shoot wildly in the market, and have at it. Yeah, we seem to have some of the 9.1%. So some people are going after that. A lot of people going after the dividend percentage, right? And there's nothing wrong with that. I'm not saying there is. I'm just saying that there's money coming in, and it looks like we sold another one. Okay, so we're getting a push up in the market. I don't know why. Don't really care. We just know that every time that we sell something, we go in and we clean up the chart, right? So 463, that was UTL. Hadn't bought anything in the last 2 days so far, which is interesting. So you got the 5th, today's the 7th. Did we sell anything on the other account? I heard 2 beeps. No, that was yesterday, and this other account, nothing. All right, so let's go to that chart, clean it up. I'm going to post that. So we'll save that. TL. Sold UTL. What's the percentage on that one? Another 3.2. And we're still moving along here. This is one that doesn't move much, right? And we've had it for a while, you can tell, but we're above water, still paying 87 cents per share per year. Energy stocks moving up. ETR, Entergy, is that Arkansas? What else we got? CBU. Let's go over to Mosaic. It's a little easier to run through there real quick. Like I say, until they finish off their little Fed meeting, you know. Volatility is kind of low. Looks like we got a buy trail in there on the VGI. We just put that in this morning before market opened. We had an adjustment to make on our max shares. We go down through here, you see this DFS, it's Discover Financial Services. So again, the financial are going up. What's the reason? No idea, don't care. Doesn't make a difference, right? And AXP, we already know it went up, so it's off the books. We already took our profit. Less risk in the market. Got this PPG coming down. Jack, that's a restaurant, Jack in the Box. And what's this one? Oh, Med. This one just, it's a big mover all the time, but we've been into that for a couple months, but no biggie. Just picked up, what do we get, 2 shares in there, something like that. Yeah, no biggie. I'll go back over to this portfolio, see if this one's actually going to hit. Hard to tell. Looks like it's coming down. Yeah, so now it's just a kind of wait and watch. Or is that one that we were talking about that was getting close? CBU. Where'd it go? LDP, ETR. Let's leave it on that for a second. Yeah, it doesn't look like anything else is going to happen before the 10 o'clock hour, or 9 o'clock if you're central. That's okay. We like it. There's it. COF. Did it get close? Yeah, still within 5 cents. You have to be patient with these markets. A lot of people can't be patient. They got to stick that money in there. Got to get in it. Got to jump. Sometimes it just takes sitting back and waiting. Don't listen to these talking heads. That's for sure. Oh, I finally picked up a long. FANG. Interesting. Hadn't seen that one for a while. Let's take a look. Classic. FANG it is. 77.20 plus 1, 79.85. post that to Twitter. All right, well, I don't know when dude is going to talk or whatever. Does it make any difference to us? We had 3 occurrences this morning, 2 sills and 1 long. We'll annotate that. And we'll be back this afternoon, 2:30 or 3:30, 2:30 Central, 3:30 Eastern. Happy trading, and don't get crazy. Remember just to stay sane. Just let the market come to you. Have a good day.